We'll wait for another 2-3 minutes for others to join, and then we'll start. Good morning, everyone. We appreciate you taking the time to join us this Saturday. Today, we are excited to explore contrarian investing, a strategy that's fascinating but often misunderstood. If you look at the quotes on the screen, some of the greatest investors in history all understood one key thing. Markets are driven by emotions, fear, greed, and herd mentality. So, what is contrarian investing? Contrarian investing is simple in concept but challenging in practice. It's about going against the crowd. When markets are euphoric, a contrarian becomes cautious. When markets panic, a contrarian sees opportunity. As the saying goes, buy on the cannons and sell on the trumpets. This doesn't mean blindly opposing the crowd. As market wisdom suggests, the public is right during trends, but wrong at the extremes. The key is identifying when sentiment reaches irrational highs or lows and acting decisively. Many investors think they are contrarians, but what if everyone follows the same contrarian idea? It simply becomes another crowded trade. This is the contrarian paradox. A true contrarian approach is not just about disagreeing, it's about enduring discomfort. When your peers question you, when your clients doubt you, and when even you second guess yourself. It's not easy. But the good news is you don't have to be extreme to benefit. Sometimes the best edge is simply having patience in a market that chases short-term trends. So you need to ask yourself, am I willing to wait while others panic? Because true contrarians aren't the loudest. They are the ones who quietly stick to their principles. So today we are going to explore how to identify these principles and these contrarian opportunities, understand why and how this strategy works, and see if it fits your investment approach. So, contrarian investing isn't about thinking differently, it's about acting when the market presents opportunities. How do we identify these moments? If you see in the chart shown on the left, contrarian investing starts with assessing a company's true value and investing when its market price is significantly below that value. This increases the potential for higher returns while reducing downside risk. However, when we buy during negative sentiment, prices may fall further before recovering. But if our thesis remains intact, this presents an opportunity to buy in more at a lower price, setting up for stronger gains as and when the market recovers. As sentiments shift, stock prices rise, often exceeding their fair value. That is the ideal time to exit, as willing buyers makes the selling easier for the contrarian. So why does this work? So markets are driven by crowd psychology, right? Herd mentality pushes popular stocks to unsustainable highs, whereas fear and pessimism drive solid but ignored stocks to deep undervaluation. Over time, as fundamentals unfold, prices correct, creating opportunities for contrarian investors to buy when others are fearful and sell when others are greedy. This is the essence of contrarian investing, identifying market overreactions and capitalizing on eventual corrections. So, we have seen how the market overreacts and why contrarian investing can be powerful, right? But what drives these overreactions? More often than not, it's emotions. So we'll talk about how emotional investing can create certain opportunities. Next slide. So here, if you see, as we've discussed before also, investing isn't just about picking stocks. It's about managing emotions also. As prices rise, optimism turns into euphoria, making investors feel invincible. But when markets wobble, anxiety and fear takes over, leading to panic selling. This emotional cycle repeats time and again, and we have seen this in the past and very recently also, right? But to succeed, investors must act counterintuitively. Euphoria signals danger. When a stock is priced for perfection, even minor bad news can trigger a sharp fall. Whereas despair signals potential. When sentiment is at its worst, undervalued stocks may be poised for recovery. Right? So contrary investors thrive in these extremes, buying when fear is highest and seizing opportunities others ignore. It's challenging, but that's where the best gains are made. So far, we have explored what contrarian investing is and how it plays out in practice. But why does this strategy work? Why do markets continue to provide opportunities for contrarian investors? I think, as we saw before, the answer lies in human psychology and market cycles, and the tendency for investors to overreact. Now we'll see why this strategy might work for you. So contrarian investing works because markets are not always rational. They are driven by emotion, herd behavior, and overreaction. Investors frequently misprice stocks, creating opportunities for those who think differently. Let's break it down. So first is market overreaction. Investors tend to overreact to both good and bad news, leading to extreme mispricings. This phenomena is known as the investor overreaction hypothesis. So overhyped stocks like high PE, high price to book often underperform as expectations are too high, right? Whereas out of favor stocks, for example, low PE or low price to book, sometimes tend to underperform as pessimism fades, right? Uh, Contrarian strategies that bet against market overreaction have historically delivered superior returns over a longer period. And we have seen this in the past. So, what is the next one? Behavioral edge. If contrarian investing is so effective, why doesn't everyone do it? Why everyone is not following this strategy? I think again the answer lies in human psychology. Most investors fall into common psychological traps. Uh, Herd mentality or herding instinct. Uh, People follow the crowd, assuming if everyone is buying, it must be right. And we have all gone through that, right? This creates bubbles and sometimes overpriced stocks. Contrarians resist the crowd and think independently, right? Another one is loss aversion. Investors fear losses more than they seek gains, sometimes making them hesitant to buy temporarily struggling stocks. So they don't go towards low performing stocks when the markets are going down, right? And another one is overconfidence. I think market swings are driven by these biases, right? Causing stocks to be overbought or oversold. So contrarian investors capitalize on these moments of extreme sentiment. Now let's look at some of the historical evidence that markets go through, right? Repeated cycles of booms and busts, providing real world proof of contrarian investing. So if you remember 99, 2000 tech bubble, right? Many overhyped IT stocks, including Infosys, which saw its price to earnings skyrocket. I mean, uh, maybe I think from 28, it went to 94, 95. Okay. And then fell drastically, leading to years of underperformance. Then you can recollect 2007 infra bubble, right? Investors chased infra stocks after the IT burst in 2000, but valuations became unsustainable, leading to steep losses over the next 5 years. Some names like Unitech, its PE jumped from 10 to almost 60. But over the next 5 years, from 2008, it lost almost 42% annually, right? L&T, another stock, very, very well known. In 2000, no one was buying it, right? But in 2007, it price to earnings rose from 13 to almost 44, 45. Again, post 2008, it gave very uh, subpar returns for the next 5, 7 years. Then another evidence is 2017-18 mid-cap hype. I mean, mid-cap stocks saw unprecedented valuations, right? But when the hype faded, I think the crash wiped out the gains, only to suffer major losses in 2019, right? So I think even the best companies can underperform if bought at excessive valuations. Timing and entry price matter more than just picking strong businesses. I think even strong businesses underperform if bought at high valuations. So, for example, I was talking about Infosys, right? So, Infosys between 2000 and 2006, the earnings grew by 35 to 36%, but stock returned just 4.2%, right? The problem, entry was very high, entry price was very high. Whereas Infosys between 2016 and 19, I think the earnings grew by only 3% compounded, right? But the stock returned 20% compounding, right? For those 4 or 5 years. Again, the reason entry price was very low, right? So the lessons, buying at the right valuation. Senthil, just go to the previous slide. Yeah, thanks. So I think buying at the right valuation matters more than growth rates. So why people get carried away in bull markets? I think one is fear of missing out. thinking the market will always rise, believing they can time the market, sometimes following star portfolio managers blindly, and also sometimes fear of looking foolish by staying out of the market, right? But that's where contrarian approach thrives, right? Contrarian investors buy strong businesses at low prices when the crowd ignores them. And what's the key behind that? What's the key behind this model? I think they just focus on buying solid businesses, capable management, undervalued stock prices, and patience to wait for value realization. We'll talk about this more later in our presentation, right? So you've seen, right? History proves that buying what's unpopular but fundamentally strong leads to superior long-term returns. Right? Now, coming to one important point, mean reversion, right? It's the core of contrarian investing. I mean, we are discussing, right? Markets swing to extremes, but stock prices eventually revert to their fair value. So when optimism pushes prices too high, a correction obviously follows, right? When pessimism drives prices too low, opportunities emerges. So very well said by Howard Marks, right? Money isn't by buying what everyone likes, but by buying what's underestimated. So most investors chase performance. Contrarians chase opportunity. The key is having the patience and discipline to invest when it feels the hardest. So now we'll just see some slides, how the indexes have reverted to the mean. So if you see here, 50p over the past few years, the historical average stands at around 20 and a half, as indicated by the red line. We can see that in certain years, the ratio was well above the average. For example, in FY19, if you see, we were close to 23. And the peak in the peak in 25 was 22.5. And currently, I think we are standing close to 18 to 19, right? Which is below the historical average. So this is again a classic example of mean reversion, where valuations that stray too far from the norm tend to return toward their average over time. Now let's examine the P ratios of mid-cap and small-cap indices. So we have to look for signs of excesses. So here, if you see mid-cap per 100, long-term average is 22.5, whereas in FY25 it peaked to 35, signaling excess valuations, right? However, now it has corrected to 27, but which is still above the historical mean. But we see this moving downward, right? And on the right, if you see the small-cap 100, long-term average is close to 16, as shown with the red line. But it reached a peak of 24 in FY25, but now has corrected back to 2021, right? So again, if we were able to pick these signs and participate when the historical average was, when the P was below the historical average, I think we'll be at a very comfortable place and play out the mean reversion very nicely, right? So another useful metric which Buffett also used to talk a lot about is assess market valuation in the form of market cap to GDP ratio, right? The historical average for India, I think, has been around 85 to 88%, as you see here. However, we see that in 24, it went to almost 132, and currently it is around 120, right? So historically, whenever this ratio has significantly exceeded the average, markets have either corrected or moved sideways for some time, right? So we need to be very careful in terms of how we are trying to identify the valuations of different indices and businesses in the market, and try to be very careful about the historical averages and whether they are trading above or below their averages, right? So yeah, next slide. So I think let's talk about something just as important as strategy. mindset. Why do some investors consistently succeed while others struggle? So it's not just about finding the right stock. I think it's also about developing the right trades. So here we are going to see some key traits. So first is alignment with the investment philosophy. I mean, whether you follow growth, value, or contrarian or momentum investing, right? Having a clear strategy, I mean, helps you focused and avoid emotional decisions, right? Take example of Rakesh Jhunjhunwala. I think he held Titan for decades because he believed in its long-term potential. So sticking to your investment philosophy is very important. Next is deep research and fundamental analysis. So successful investors, I think, don't follow the herd, right? And we have seen this in the past. They analyze financial data, market trends, and sentiment indicators to make informed decisions. I think they understand that investing is about probabilities, not guarantees. Long-term perspective is key. Ability to see beyond short-term trends, right? We have seen markets fluctuate like a pendulum, right? But contrarians know patience pay off. They hold on to strong investments even when they underperform in the short term, waiting for sentiments to shift in their favor, right? So there are some key mantras for a long-term successful contrarian investor. One is having strong conviction. That is, being contrarian isn't easy. You're often buying when everyone else is selling, right? So if your research isn't solid and you cannot hold on to your investments, then you will suffer losses. But if your research is solid, the market will eventually catch up. Another important mantra is loads of patience is required. So contrarian is not just about quick profits. Some investments takes months or even years before they pay off. But when they do, the returns are worth it. And another one is flexible timelines. I think the markets, as we all know, will not work on our schedule. Instead of asking when a stock will rise, we should focus on whether we have bought the right businesses and it's fundamentally strong with good growth prospects, right? So we sometimes the willingness to change or challenge the conventional wisdom is very difficult. But the best investors generally buy when others are fearful and sell when others are greedy. Take the example of COVID-19 crash, right? I mean, investors who bought during the panic doubled their wealth in less than 2 years. That's amazing compounding happening, right? So we need to be very, very open to challenging conventional wisdom. Another one is emotional discipline and risk tolerance. Markets can be volatile, but successful investors stay calm. They avoid emotional reactions and stick to their investment theses, even when they are faced with a lot of criticism or short-term losses, right? So sticking to your discipline and maintaining your risk tolerance is very important. And the last one is, I think, curiosity and independent thinking. Great investors keep learning and questioning. Instead of following the media hype, I think they rely on their own analysis, trying to spot opportunities that others may be overlooking because of various reasons, right? So, end of the day, investing, be it any approach, is a mental game. I mean, you have to stay disciplined, stay patient, and stay curious. I think if anyone can master these traits, I think you won't just survive in the market. I think you will thrive. Yeah. Now I just request Senthil to come in and take us through importance of independent analysis and how that can help a contrarian investor.
Thanks, Gaurav. Thanks for the introduction of all the key characteristics that gets into a contrarian investment strategy. Just continuing from that, so one of the key important trait is independent thinking, right? So because if you see that uh, in any contrarian opportunity, when you are analyzing and you are studying, most of the inputs that you will be getting, so like right from the mainstream media, like from the newspapers, to the media channels, and of course from the brokerage reports. So I think 90% of the data will be saying that whatever the market reflects in terms of valuation is correct. So it will be very tough to take a counter view, because it's not just a story, right? Because you will see reports from brokers stating that why should this sector or why should this company trade at a lower valuation compared to the historical numbers, because these are the headwinds that they are saying. So at that juncture, right, an investor will be mostly tend to go with the trend, because uh, whatever we see, whatever we read, right, I think we will be acting on that basis only. So that's where I think it will be tough to have an independent thinking view. So we will cover a couple of slides in terms of where, as a fund house, right, where we are seeing contrarian opportunities and how we are viewing and how we have taken decisions in the past also. Uh, yeah. As present, right, I think most of you know that one of the key issues that the banking sector is facing is that one of the key headwinds is that the liquidity. So the as a sector, the if you see that because of inflation and a lot of issues, I think the central bank has taken a call in terms of tightening over the liquidity. But of course, now the last few weeks, if you're reading that, I think they are looking to ease the liquidity a bit. And we have seen a rate cut also, and we are expecting a rate cut in the coming review next month also. So if you take back a year and then see, um, most of the market news will be tend towards that liquidity is tightening, and then the FIIs are selling. So if you see private banks within the index, banking as a sector has close to one-third weightage. Of course, FIIs weight will be proportional to that. So FIIs, if they are selling, then there will be disproportionate amount of selling will come in the private banks and banking sector space. So that's one way. And the second way, in the fundamental side, with liquidity tightening, and then there is a whole lot of consumption slowdown. I think all those things will see that, okay, this sector is not going to perform. So why should we be in this sector? But on a view, what we have to see is that all these are factored in the valuations. So what are the current valuations? If you see private banks, in terms of price to book, on a 10-year basis, the average is close to 2.5 times. During COVID, I think it has come down below 2, and then it recovered. But what's the current stage? If you see over the last couple of years, they have been trading below their 10-year average because of fundamental factors. Of course, on the technical side, we have seen flows moving towards public sector banks, because public sector banks post COVID, I think they came back very strongly in terms of having written off all their bad loans. Their overall balance sheet got strengthened. It was very clean, and the valuation was very comfortable. So there have been flows towards public sector banks as a market, and then plus all these fundamental issues in terms of loan growth and things like that. So as a sector, I think valuations got tempered. So that's the current situation now. So what the situation going forward? So as we have seen, RBI has taken steps to ease the liquidity. So even they are doing a open market purchase of government bonds on 25th. So I think and next week they will be doing a open market operations to ease the liquidity. That's first step. And rate cuts has been second. And on the budget side, I think government has acknowledged the impact on inflation on urban spending, and they have taken a tax cut. So that will give like a 1 lakh crore of boost towards consumption. And fourth would be the next 15 to 18 months, you will see a one major consumption boost via eighth pay commission. So if you read the current news, right, I think eighth pay commission would not be in the news as of now. So none of the brokerage reports or the mainstream channels or the experts interviews, nobody is just factoring in the 8 pay commission. Because if you look back 10 years back in 2016, when the last pay commission came in, right, the amount of impact that had on the discretionary consumption, especially, it was very good because we have done a backward analysis on how the seventh pay commission and its impact on the consumption sectors. We found that especially on the discretionary side, post the seventh pay commission implementation for the next 2 years, the rate of growth, especially in the auto sales, right, from the passenger vehicles, two-wheelers, it has grown at a rate of 3 to 4% higher than the long-term average. So this will happen over the next at least 15 months from here. But none of the current news is factoring in that. But as a house, right, I think we take a 3-year view in any of the investment decisions, and by taking this 3-year view, we take a long-term view and we factor in that, okay, next 15 months, we will get this boost, which will be a major consumption boost. And if you take as a percentage of GDP, right, last pay commission, the impact on the GDP was that almost close to 0.7%. And this time, I think the expectation is that it will be close to a 1% kind of positive impact on GDP. So over the next 2 years, I think that will play out, but not in the medium term of next 2 quarters. So that's where the consumption will revive both on the urban side. And of course, we have seen that last 2 quarters, rural has seen a much better revival with the good Kharif and even with better water reservoir levels. We have seen Rabi crop also is coming out very well. So with both rural and urban coming back, and then overall the RBA taking care of easing the liquidity, rate cuts. So all those things will play out over the next 15 to 18 months. By taking that view, right, I think with this kind of valuation comfort that we are getting, we find this one opportunity and across funds, right? I think True Blue, we have good overweight position in this sector. And just another example where Solitaire. So in Solitaire, we have a very overweight position on consumption. And as I explained in the last slide also, if you see with the tailwinds coming in over the next 1 year, what is the valuations that? So if you see the consumption consumer PE 12-month forward, 10-year average is close to 42, but now they are trading at around 39 times. Even on it, if you take a price to book, right, I think it's trading below the 10-year average of 10. Now it's at around 9.3 times. So both with tailwinds coming in and valuation comfort, if you are positioned like this, right, I think once the tailwind started playing out, you will not only get the positive benefit of earnings growth, but also the re-rating benefit. So that's where the alpha creation happens. But for this, right, I think as Gaurav mentioned earlier, our research has to be very solid and our risk management has to be in a pristine position because taking a contrarian view away from the uh, across what the mutual funds or other PMS are doing, we have to have a position sizing limit and risk management has to be embedded in to see that the strategy is well played out. So yeah, so that's a couple of examples in terms of as a fund house where we are seeing contrarian opportunities. And uh, so globally, right? Globally, if you see in the last decade, uh, both on the FII side and also large institutions, they have taken very much comfort in the US market. This has to be particularly because we have seen this the US top 7, what they call as the technology leaders. So they have grown ahead of the global growth because you see bulk of their revenue is coming away from the US. So it's not that they are based out of US, but majority of the revenue is coming from across the globe, except for China, where they have their separate own technology market. So because of this outperformance in terms of growth plus scale, so these technology startups having a global scale, they generate a free cash flow that is very much higher than what our consumption companies generate in India. So because of all those benefits, right, I think most of the funds globally has taken a very much comfort position in US. Here, the main idea that we are just trying to bring out is that uh, when we should not have an incremental flow where already the market has taken comfort, because all the valuations, all the incremental growth that is expected is already factored in the valuations. And when valuation is pristine, any like what we have seen in the last couple of months with respect to the AI, like because with couple of news coming from China in terms of having their own low cost AI technology, you have seen the kind of crash that has happened in US, especially in the AI companies. Uh, so the valuation is clearly not comfortable over here. And this is just for an example to show that uh, being uh, comfortable is just opposite of taking a contrarian approach, because well, buying it to US market may be very much comfortable now, taking into view that they are they are the market leaders, global leaders in terms of technology, but that won't uh, give you returns what you expect because it's already factored in. So that's just on last example globally to point out what's happening. And like I mentioned, right? So taking contrarian is that you have to be in areas which are completely unpopular. Uh, like I mentioned earlier, uh, pre-COVID. So if you see the banking space, right, uh, from the year of 2013, 2014, uh, especially on the public sector banks, they have started showing incremental non-performing loans versus the private banks. This is because in the previous regime, like post 2008, uh, there has been a lot of loans that has gone into corporates or gone into sectors that were not generating that kind of ROE, or there are a lot of uh, defaults which were expected, but the risk management was very poor in the public sector banks. So that took time to reflect in the public sector banks, and that started reflecting right from 2013, 2014. So from 2014, for the next, at least for the next 6 years, you can here see that it's like a parabolic. So the gross performing loans of public sector banks shot up from like 3-4% to almost double digits. During this phase, it was a worst phase to be in the public sector banks because uh, they were facing a lot of issues on the growth. Along with that, their balance sheet is getting weakened every quarter after quarter. You might have seen that SBI results during this period that will clearly show what was the pain that PSBs were undergoing. Uh, so once this cleanup was happened, and then if you see even pre-COVID itself, the trend has reversed. So from upwards of 11-12% kind of cross performing nodes, it has started coming to almost single digit. The trend has reversed. So this is where the research that gets into, like, we have to be watchful of trend, and then the moment we see that okay, the entire cleaning up as the pain, majority of the pain of cleaning up has happened, and now it is starting to ease. And post COVID 21-22, I think they were almost coming to a stabilization in terms of operations and risk management. And we have seen the kind of return post 21 with public sector banks outperforming the private sector peers. Uh, so, two things that went in for this is that uh, triggers, especially, is that management and strategy. This is just one example. Suppose in any contrarian idea, right? When the company is undergoing a difficult phase, and then the management is coming out on saying that, look, this is a problem and this is what we are trying to do. For example, just for an example, this one of the Nifty stock, like M&M. So if you look at M&M, right, um, pre-COVID, over the last decade itself, they went in for a lot of diversification. Globally also, they acquired a company in Korea, like Samsung on the automotive side. And a lot of these acquisitions were not turning out to be profitable. And because of that, the company started underperforming. And then over the last 3 years, what the management did was that they started entire new strategy in terms of segregating their entire businesses into three categories based on the ROE and the growth. And then what they did was that whichever the businesses that comes in the last category, either in terms of growth, in terms of ROE, they started divesting it. So simply by because of cleaning up whatever the bad businesses that they had, incremental flows, incremental management bandwidth started reflecting in the best part of the businesses. So the best part of the business is first one is the tractors, because tractors they make close to almost 20% of their operating profit. It's a very highly profitable for them, and they're the market leaders. And second, on the passenger vehicle side, so they came back strongly. A lot of new launches were very successful for them. So these are a couple of triggers that uh, helps you in finding that opportunities and see that whether these opportunities will play out as expected. So these are a couple of examples just for understanding. Yeah, over to Gaurav to take it up.
Sure. Thanks, Senthil. So now that we have explored some interesting charts and how the things have panned out, and also looked at some principles behind contrarian investing, let's focus on the most important part now: how to apply these strategies in today's market. So, so contrarian investing isn't about blindly going against the ground that we have established, right? It's about strategically identifying mispriced opportunities and acting with conviction. If we do these two things, I think it's we are home, right? But how do we do that, right? So we need to identify market sentiment extremes. Sometimes markets tend to overreact, as we saw earlier, right? Whether to good news or bad news. Sometimes stocks, sectors, and even asset classes as a whole often become either too loved or too hated. And contrarians look for extremes in sentiment because that's where opportunities emerge. And as Senthil was mentioning, right, buy the unloved or unpopular sector, right? So a key contrarian strategy is to invest in stocks or sectors that are currently out of favor. If a fundamentally strong company is ignored due to short-term concerns, it can present a great buying opportunity. If you remember, I think in 2016, that Maggie controversy happened and Nestle corrected, right? So that was a very good time to participate because it was a short-term problem and you were getting a business like Nestle at a very historical lower valuations, right? Another point which Senthil was saying was sector rotation, right? Markets move in cycles. What is loved today might be unloved today, might be in demand tomorrow, right? So contrarians shift investments into underperforming but fundamentally strong sectors before the market catches on. If you remember, in 2000, I think 19, the Nifty Pharma PE dropped to 28, and then in March 20, it dropped to 20. Whereas the historical PE of Nifty Pharma is anywhere between 40 to 45, right? And during this phase of 2019 to 2020, the EPS of this index grew by almost 40-50%, right? So market clearly overstated the risk and that clearly created a buying opportunity. And we all know how pharma did in 2020 and early 21, right? So sector rotation, how we play it is very important. Another is crisis investing, right? I think some of the best opportunities arise in times of market panic. During downturns, investors often overreact, pushing stock prices far below their intrinsic value. We also need to keep an eye on fund flows and also the media sentiment, right? Paying attention to where capital is moving and what the media is unanimously bullish about, whether a trend or a sector. Sometimes, and it's often too late to enter them, right? On the other end, when the fund flows indicate extreme pessimism, and it might then the media has stopped talking about some particular sector or particular businesses, right? I think that might be a good contrarian entry point. Obviously, we need to look at various other things, but it's just a signal. And as we discussed earlier, we need to maintain emotional discipline, but also at the same time have an exit strategy. It's very difficult to stick to a plan, and for contrarian investing, it's even more difficult, right? Because market tests your patience. If you don't have a clear exit strategy, whether it's reaching fair value or change in fundamentals, right, or a shift in sentiment, if you don't have that strategy in place, you may not play the whole contrarian cycle very well. So you need to be extremely emotionally disciplined and have a very, very clear exit strategy. Also, we need to stagger and diversify our entry points, right? Instead of going all in at once, we need to spread our investments over time to manage risk and also capitalize on price fluctuations. As we discussed earlier, sometimes what we buy can continue to fall more. So we need to be prepared to buy more at lower prices even after we have identified the idea or the sector. This can only come if you have a very clear investment thesis and a catalyst in place. Buying a stock cheap, I think, isn't enough. There must be a catalyst that can shift market sentiment. I mean, it can be anything. It can be earnings growth or business turnaround, or just improving the overall macro environment of that particular sector. But there has to be some catalyst for your thesis to play out. We need to obviously stay updated in today's fast moving information world, right? Obviously, all the information is available, all and more. I mean, you have much more than what you need. So we need to be very careful because markets are filled with sensational news and short-term speculation, right? And every day someone is coming and speaking about something or the other, right? So I think the contrarians stay informed, but I think they ignore the noise and they focus on long-term trends and don't get disturbed by any short-term movements or short-term trends. Another important point is that you need to use the sentiment indicators. You need to closely watch them. So contrarians look just beyond emotions, right? And this also focus on fundamentals like PE ratios, price to book, and many other matrix like discounted cash flow models, etc., right? Which help identify undervalued stocks or the trends. So one thing is that you can use the VIX volatility index as an indicator, right? Low VIX sometimes is equal to overconfidence at maybe a potential market bubble, right? Which we saw very recently, right? And high VIX is panic, which is a contrarian buying opportunity. For example, if you see March 2020 in the COVID crash, VIX hit a 12-year high. Clearly a contrarian buying opportunity in 2020 March. So contrarian investing, as we see, isn't about being different just for the sake of it, right? It's more about spotting mispricings, waiting patiently, and acting rationally when others are not. If we can master these strategies, I think we'll be on our way to turning market irrationality into opportunity. So these are some of the strategies that we can apply, but obviously a lot more goes into applying these strategies in the today's market scenario. Yes. Next. Yeah. Yeah, Senthil, you can take through this slide.
Yeah. So, like we already discussed this slide, I'll just move to the next one to explain on the valuation metrics. So I think among the key factors that goes into the strategy, I think the highest factor could be the valuations. If you see that um, just if you have access to screener, so if you just take a filter and then just do a filter for a list of companies with a market cap of greater than 5,000 crores, and then last 7-8 years return less than 5%. This is on absolute terms. So if you do that, you will get a list of ideas, and among them, you will also find like at least 10 to 12 stocks which are very well known, and which are like a couple of MNCs will be there and things like that. So the main reason for these kind of good businesses not performing over a long period of time is that mainly is because of the high valuation during the entry period. So whenever the stock gets into a zone where it doesn't justify the future earnings growth, and also the ROE. These are two metrics, right? So even though ROE will be maintained, if it is a very good business and it has scale and market leadership, the business can maintain the ROE. But if the growth doesn't justify the high valuations, then obviously the what will happen is that over the long period of time, it will be going into a phase of time correction, or even a steep correction can happen, so that the derating will happen. So just for example here, this is a B2C consumption company. If you see that over the last at least 8 years, the stock hasn't given any return. So the main issue that has went into here is that the highly the story was very much popular during those 2018 small cap boom and 2000 during those period. I think almost the market was very excited for this company and things like that. So the market started giving sky high valuations to this stock. So that's where one of the uh, most like quote from Warren Buffett was that when we pay a very high price, then that's just for cherry consensus. Then obviously the future returns will be very low. So here you can see that for the same company, right? This is the PE chart and the trailing 12 months CPS. So here you can see that during the 2008, 18 and 2019 during period, you can clearly see that the P started inching up almost towards 60 times, 80 times, and during the last peak, I think the P almost went up to almost 130 times. So for a company to trade above 80 times of PE, then obviously the earnings growth has to be upwards of 30-40% to maintain this kind of overvaluation. So then only next 2 years, the earnings growth will 30-40% will come in and the PE will start to normalize. Suppose if the earnings growth start to flatter, like what we are seeing here, then that will result in a steep drawdown. So that's what exactly happened in this stock. So the initially the P was overrated, so the P went up to upwards of 100. Then the earnings started flattering. So these are like a rocket with double engine failure. So so if it is both the engines got failure, then obviously the stock will crack. Uh, uh, so this is one of the key risks in a contrarian investing, like when you are with the comfort zone. So but taking contrary view, obviously we won't be entering this stock because the first point of valuation comfort is not there. So that will itself will help you in avoiding these kind of overvalued stocks and sectors.
Sure.
Yeah, over to Gaurav.
Yeah, thanks. So thank you, Senthil, for that insightful breakdown of the valuation metrics, right? So another important question, right? How is contrarian investing different from value investing? Like while both strategies focus on mispriced opportunities, they do differ in approach. Value investing is driven by fundamentals, buying financially strong companies, trading below intrinsic value. And contrarian investing, as we saw earlier, looks beyond valuations. It factors in market sentiments, psychology, and macro trends to find opportunities that others ignore. So value investing can be called as a subset of contrarian, right? Contrarians use sentiment indicators and psychology to identify extreme market reactions, and value investors rely more on valuation models and financial metrics like look at PE, PV, DCS, right? Now, it depends on your mindset and risk tolerance to choose either of these. Contrarian requires more patience and resilience to withstand short-term losses, whereas value investing demands extremely deep research and conviction in financials and able to understand financials very well. So I think in reality, many great investors try to blend both strategies, challenging sentiment while staying grounded in valuation also, right? So yeah, so that's the difference and the similarities between these two. We'll now move forward and look at now we have understood the difference between this one. So let's see what contrary investing risks are, right? So basically, we are very clear and very straightforward. Timing and market irrationalities, right? We have seen this before also. I mean, markets can stay irrational much longer than expected, right? A very famous saying by Howard Marks is that being too far ahead of your time is indistinguishable from being wrong. So patience is the key in contrarian investing. Value traps. I think not every cheap stock is a bargain. Some are fundamentally broken due to bad management or high debt. So we need to be very careful that. Another is psychological risk, which we have discussed before. So going against the crowd is tough. It's not easy. And underperforming while others profit can test your conviction very deeply. So you need to be extremely strong and emotionally disciplined in contrarian investing, right? And it does require high research, demand, and understanding market dynamics also. Contrarian investing isn't passive. It requires deep research as irrational valuations can persist much longer than expected, right? And as Senthil was talking about volatility and position sizing earlier, right? The stocks, contrarian stocks can be volatile. So diversification is the key in terms of managing the risk. And obviously exit strategy, which we discussed earlier. Buying low isn't enough. I think you need to know when to sell because that will ensure that you lock in your profits before sentiment shifts again. So it's very important that you, this is some basic risks that we have discussed. So very important to keep a close eye on all this. Contrary investing demands a lot of patience, deep research, and also emotional discipline. If you can manage these risks, I think it can turn out to be a very powerful strategy, right? So now, as we try to conclude, let's try to bring everything we have discussed back to Solitaire, our flagship product, right? So how our approach is integrating contrarian investing, behavioral finance with long-term wealth creation. So at Solitaire, our investment philosophy is deeply rooted in behavioral finance, focusing on being patient, being disciplined, and focusing on long-term compounding, right? We recognize that controlling and mastering one's emotions often matters more than technical expertise in achieving sustainable wealth creation, right, for our clients. As you see in this chart also, Solitaire's positioning is always trying to play away from the crowd, right? A hallmark of contrarian investing. While the broader market chases short-term trends, we focus on identifying high-quality opportunities that are temporarily overlooked or maybe mispriced, right? Our approach is bottom-up, selecting businesses based on fundamentals and not hype. So it often turns out to be contrarian when sentiment is negative in some of those businesses that we have, right? Market volatility tempts many investors to react impulsively. At Solitaire, we are trying to emphasize rational decision making over emotional reactions, ensuring that our portfolios try to remain resilient, right? And our focus is purely on prioritizing buying companies with high ROC, low leverage, and strong business models, right? Ensuring financial strength of the portfolio, even in challenging markets, because that's what will bring conviction to your investment thesis. If your fundamentals are not strong, you will wobble in tough times, right? So we are trying to guide our investors and understand ourselves also, and keep saying ourselves that we have to stay committed through market cycles, avoiding the pitfalls of panic selling and short-term speculation. That's what we saw over the last 1 month. You would have noticed how the panic selling happened, and this week gone by, the index have recovered 5%, which has not happened in a very long time, right? So ultimately, I think Solitaire isn't just about generating returns. It's about mastering the behavior that drives them. I think by combining some contrarian insights and disciplined investing, along with behavioral coaching, I think we ensure that we are trying to position our portfolios for long-term success, right? So I think that's all from my side. If you'd like to add anything, Senthil, to this, please do.
No, I think nothing else. Just one a bit on the disclaimer slide. So what are the stocks or sectors that we have discussed so far is just to explain about the contrarian side and what the strategy we follow in our fund. So just a basic disclaimer, just this is not a buy or sell recommendation, and please consult your financial advisor before acting on it. Yeah.
Great. Great. Thank you, everyone, for being a part of this session. I think we'll look forward to help you navigate your investment journey with confidence. If there are some questions, we'll quickly take them and then we'll end the session. I think we've already got some questions. One is as of March 2025, the Buffett indicator market cap to GDP for the US is given. So I think, yes, this question, while the 25 median value is 80%, but the market is still going up, your opinion. So I think the Buffett indicator currently around 190%, right, is obviously flashing red, many red flags compared to its 25-year median of around 80 to 90%, right? So historical standards, if you see, that's deep into overvalued territory. But here's the thing, I think we discussed this in our presentation also. Markets don't rise or fall on valuations alone. Sentiments play a very major role. And right now, what we are seeing is a perfect storm of bullishness or bullish drivers that can be explosive growth in AI and tech and strong corporate earnings from this tech companies, right? And also some expectations of Fed rate cuts later this year. I think they have announced 2 more cuts this year, right? So these forces, I think, are trying to outweigh traditional valuation matrix, at least in the short term, right? But I think what you mentioned, right, the Buffett indicator is a very powerful long-term signal. It doesn't predict when a correction will happen, but it does remind us that we are in a stretched territory, both in the case of India and also in the case of US, right? So while the rally may have many legs, I think it's time to stay invested wisely. And as always, we have to focus on quality, manage risk, and don't chase momentum blindly. I think the higher we go, the more the discipline matters. So we need to be very, very careful in how we are trying to manage that. So I think one more question that we have is which sector in India is unpopular now? So I think if you're talking about sectors in India, there's a very mixed list, right? I will not talk about whether they are unpopular or not, but I'll talk about some sectors and what's happening in them, right? So let's take pharma. I think during the COVID, and we also saw how it performed. It was one of the hero sectors, right? It's out of the limelight right now. I mean, it can be because of regulatory headwinds or because of pricing pressure in exports and the tariff pressure from the US government, right? And also muted earnings have kept investors away, right? But I think the long-term fundamentals, given India's strength in generics and global pharma outsourcing, are still intact. So we don't know. This sector might be quietly building its base for the next move. So we need to keep a very close watch on this. Also, we have to look at the small caps, right? I mean, the Stellar 23, 24, the space is starting to cool off, but still valuations are above the historical average. And because of SEBI's cautioning and volatility has crept in, we have seen some downward movement. But sometimes in these corrections, which are healthy for the overall market, and those with a long-term mindset and very, very strong filters can find extremely good businesses in this downturn, which can bring massive and very, very high potentially good returns over the next 7-8 years if you are able to identify those businesses well. So we need to be very careful, but there also a lot of opportunities can open up, right? And another sector that we have been seeing going through a tough time right now is IT. I think the global demand slowdown, the margin pressure, and cautious spending by the client because of various reasons, right, have made this sector go slightly quieter over the last 1 or 2 quarters, right? But I think, again, though we are not the innovators, but we are providing the entire GCCs or the back office to these guys who are innovating, right? So we might see some thing happening, very interesting happenings here, and currency tailwinds also could revive interest in this sector very, very quickly. And also, Senthil was talking about FMCG, right? I think this sector is traditionally seen as defensive, but it has been under pressure due to weak rural demand, inflation in raw material costs, and subdued volume growth also, right? While it's not exciting right now, many FMCG names are fundamentally strong businesses, and the right time to buy them is when they are going through some tough phase. Maybe when rural consumption revives, maybe Senthil was talking about eighth pay commission, right? And sometimes it eventually will revive, the consumption will come back. I think this sector could quietly come back into favor. So, yeah, these are some of the things that we are very closely tracking. Senthil, if you would like to add something more on FMCG, and there's a question on auto also.
Yes. So there is a question that is auto, yeah, contra sector now. Within auto, right, I think there are a lot of sub-segments, like we have passenger vehicles, we have two-wheelers, we have commercial vehicles, we have tractors. So each and every sub-segment undergoes a cycle of its own. So if we see currently passenger vehicle, even FY25 is expected to grow at like a 2 to 3% kind of growth. Because previous 2 years has been very well in terms of passenger vehicle. They grown at around double digits in FY23, FY24. So now I think they are getting into a kind of phase where the growth rate will be normalized over the next 1 year. Then post that, as we discussed earlier, the consumption boost from the government will help them grow higher, right? That's on the passenger vehicle side. If you look on the tractor side, I think tractors, we are clearly seeing that tractors is coming out of I could say like bottoming out in terms of cycle, and even last quarter was very good, and Q4 is also very good, and next at least 1 or 2 years I think tractors good do well. So on the auto side, I think we have to take a call sub-segment wise. So it's not like a broad-based auto sector call. We have to take a sub-segment call, and then within the sub-segment, you have to take which stocks can do well. Within passenger vehicle, we have to see company-wise what are the new product launches and things like that. So that's where auto is a very bottom-up and also sub-segment cycle level. You have to take a call, not a broad-based call like that of a private banks or a consumption. So that's where our view stands.
I think there's one more question on FMCG, Senthil. It's saying still FMCG P is not fairly valued or cheap at this point of time.
Okay, yeah. So traditionally, if you see, right, I think over the last at least from 2011 period, I think the re-rating of FMCG started, and so why the market tends to give a higher PE to FMCG versus other sector is that first, the stability in terms of sales. So if you see a sector, suppose for example, even if you take a auto, they undergo a lot of volatility at the sales level, the revenue level itself. Then comes the profit level, like operating profit level, margins, volatility, and then the bottom line. But if you look at FMCG, right, at all levels, starting from the sales level, then to the margin, and then to the bottom line. So all these levels, I think, if you look at the history and the the metrics will be almost be stable. So the volatility will be very, very less. So that's where if you do a valuation in terms of either DCF or a price to earnings, I think the current P we have to match it with the stability in earnings and also the ROE, because these companies are very asset light, right? I think they generate substantial free cash flow. 90 almost, I think 90% of the cash flow will be only free cash flow. They give out as dividends, or they keep it on cash on books for acquiring companies, for inorganic acquisitions. So these are like FP free cash flow companies. So from the angle of free cash flow generation, ROE is upwards of I think mostly it will be like 50-60% kind of ROE. I think no other sectors in India does ROE of this level, along with stability in revenue. So that's where the FMCG has to look. And already they have gone for a time correction. So in the slide, I think we have shown, if you see the last 2-3 years, I think because of the so if you see post-COVID, what has happened was that we went for an inflation period. Globally, all the commodities went in for a huge inflation. Then there was a deflation, and then there was inflation, and then now we are seeing some sort of deflation. So this inflation deflation cycle, the FMCG got into a kind of demand issues, because they were not able to take a price hike, then demand slowdown. So that's why the growth was not up to the level over the last 3 years, and that's reflecting in the time correction that the sector has gone into over the last 2-3 years.
Yeah. There's one question on private banking and consumption. They're the top potential sectors, and me being in early 40s and with 10-year horizon, is a good time to start a PMS. So I think we'll try to address it into two questions, right? First, let's look at the sectors, private banking and consumption, and then the long-term portfolio, the PMS that you want to start, right? So there's a strong case that we can make for private banks or financial services as a whole, and also consumption. Senthil spoke about consumption, right? So private banks or financial services are fundamentally solid. I think they are well capitalized right now. They have high CASAs, right? Ratios. NPAs have come down extremely, and this credit growth is looking to come back, right? And especially we're seeing some signs in retail and SME space right now. So, and many of these banks have embraced tech also, which will improve efficiency and reach. So, as the Indian economy grows from current places to compounding at 8-9%, right? So, financial penetration is only set to go further deep, right? So, private sector banks are positioned, I think, in the right place, and they're in the center of that to make the most of it. So, yes, I think if you have a very long-term view, there are a lot of tailwinds, strong, solid long-term tailwinds that are there. And consumption also, as Senthil was saying, right, the long-term structural story, I think, is available, clearly visible. Rising disposable incomes, urbanization, and premiumization trends, right? And aspirations of young population all are going into this consumption, discretionary consumption theme, right? Be it FMCG or discretionary products to maybe autos or durables. The consumption basket is very diversifying, very diverse, and also it's expanding. So you need to keep a very close watch in terms of what you're buying and what you're paying for these businesses, because there are a lot of businesses that are extremely overvalued. So you need to be very careful what price you're paying to buy these consumption businesses. So yes, I think in general, while sector leadership can rotate, I think private banking, consumption, auto, all these are themes with solid long-term tailwinds if you have a 5-10 years view. They may not always lead in the short term, but I think over a 10-15 year horizon, I think this can compound well along with the economy, right? So it's very important that you keep a very close watch and buy businesses which have strong fundamentals at the right valuation. Whether it is, even if the sector is showing promise within the sector, also you need to be very careful what you pick, right? So that is very important. Now coming to the second question, starting a PMS, right? If you have a 10-year horizon, so I think it's a great time to consider it. You have visibility of cash flows. You're in the wealth building phase, I think, right now, and assuming you have a stable income, right? So you have the opportunity to deploy your capital systematically. PMS, whether it's iThought or anyone, I think they can bring in concentrated high conviction portfolios. They can bring in active allocation across sectors and market caps, right? PMS brings professional research and risk management, and sometimes offer more customized strategies than some basic standard mutual funds, right? So the key, of course, is choose the PMS which fits your needs and requirements and your risk appetite, and you understand the investment philosophy, and you are okay to go through that cycles of that portfolio, right? And you were mentioning, right, you can bring in capital as required. So I think a staggered approach over the next few quarters will help you average out the market volatility also. That's a very good strategy to look at. And currently markets have been trading slightly at a premium valuations also, right? So overall, I think you need to see whether your risk appetite is there, and you have a time horizon of 8 to 10 years. I think then PMS can be a very powerful wealth creation tool. But especially if you pair it with disciplined capital, such consistent capital inflows, I think then it can be an extremely powerful wealth creation tool for you. So I think we have covered the questions on auto and FMCG. If there is anything else that you would like us to cover, kindly put a note.
I think there's a question on auto components.
Yeah.
I think again, similar to what we have discussed for the auto side, I think even if it is not for the auto components, I think the idea of looking how the stock has corrected from the 52-week high doesn't fundamentally is not sound, because a stock might be very much overvalued at 52-week high. So from that level, right, if you're saying 20% correction and then 40% correction, it doesn't mean that just by being 40% correction, it comes in the fair value, because the starting point itself is very sky high. So if stock has a PE of 100 and then from there it corrects 40%, doesn't mean that it's appropriate fair value. It's now trading at around 20 times or something like that. So that's where even it is not for auto component, any sector, any stock, you have to look at from the angle of what's the current earnings, what's the next 3 years earnings potential, and then the current stock price. So the drawdown, it's good to look at initial criteria that okay, there has been some correction look, but that won't be a main criteria to pick the stock. Yeah. Again,
There's one on chemical sector. So I think for chemicals, if you remember during the post-COVID recovery phase, right, Indian chemical companies experienced a major boom. Almost all of them, like because of global supply chain disruptions, right? We also saw China plus one strategies playing out at that time, and elevated realizations, all contributed to stronger earnings and massive re-ratings in this sector, right? From specialty chemicals to agrochemicals, you take bulk APIs, the entire space saw a sharp uptick in both investor interest and profitability of the companies, right? But I think currently the narrative has changed slightly because of input cost pressures have risen, especially pricing power has come down as global supply chains normalize and demand has softened. China's reopening has also played, and price aggression have increased competitive pressure in exports, right? So inventory corrections are ongoing in both domestic and global markets right now, which is affecting the volumes also, right? So many companies have reported margin contraction and slow revenue growth over the last 2-3 quarters, right? So that's what is happening on chemicals. But on the positive side, if you look, the long-term China plus one trend, I think is still intact, right? With the clients continuing to look at Indian manufacturers for diversification. Capex cycle, I think, is still continuing in select companies, right? Indicating the management confidence in future demand. Right. At the same time, India is increasing push for manufacturing and becoming self-reliant, and PLI schemes coming in chemicals, right? And intermediates also could be very, very supportive in the medium term, right? So the sector benefits from its linkages and downstream industries, right? You take pharma, textile, paints, agriculture. So structurally, I think the demand is relatively broad-based. So at this point, chemical sector is navigating, I think I would call it like a mix of short-term cyclical headwinds and long-term structural opportunity, right? So whether this current phase is temporary or it's a start of a longer consolidation, that's something we'll have to wait and evaluate as things play out. And we need to be very stock specific, and we need to see the sub-segments and company level execution to bet on some of these names. There's a point on tourism also, Senthil, if you would like to cover that.
So there is a question on consumer durables also. So consumer durables, again, I think what are the data points that goes into for FMCG, right? On the consumption side, either it be the budget boost and the upcoming pay commission revision. And the main issue with the urban consumption, what has happened is that the wage growth doesn't haven't been keeping up with the inflation. So that's a key reason for the slowdown in urban, and that was highlighted across all the FMCG companies management. So that has started to ease a bit. So I think that will be the key tailwind for consumer durables also. Because we have seen within the consumer durables, the premium products have been doing well, but the low end and then the mainstream products hasn't been growing that well, because those are the customer segments who have been impacted by the inflation. So consumer durables, I think we have to look at from that angle in terms of demand. And again, on the tourism side, I think tourism is a very long term potential, and as a house also, we are very quite positive view on the entire tourism sector. And I think of late, I think we have seen a lot of new companies from the travel and tourism sector getting listed. So we have seen both on the online travel, the tourism operators, OTAs. We have seen 3 or 4 of them getting listed, and a lot of B2B operator also getting listed. So tourism is one sector that offers a lot of potential, but we have to be cognizant that even there you will see like periods where the sector gets into a bit of volatility, because that's depending upon the global economy, the domestic economy, because any changes, any slowdown in either be the global or domestic economy, that will be reflecting in the tourism part in an exaggerated way. So that you should be cognizant of.
So I think there is one more, I think, China-based opportunities. I think, as we are discussing, right, the China plus one opportunity is real, but I think we need to be selective. It's not a quick overnight shift, but it's a multi-year transition where companies with scale, compliance, and extremely high execution capabilities will benefit. Now, whether India can fully capitalize on it depends on how we handle many things like infrastructure, logistics, ease of doing business, and policy stability, right? But I think the direction is clear. Global supply chains across the globe world are diversifying, and India is very much on the radar to capture a portion of it. So yeah, I think it's going to be very interesting. So I think if there are not
Yeah.
any more questions, I think we'll end the session now. And if any other queries you might have, you can just drop us an email. I'll just put our contact us page here. And if you'd like to reach out, then you can please reach out through your advisor, or you can drop a note on our website also, and we'll be happy to connect. Great. Thank you. Thank you everyone for joining in Saturday morning and spending time with us. I really appreciate it. Thank you. Thank you so much.
Yeah. Thank you. Thank you, everyone.